You should not pay a financial advisor to invest your money in the S&P 500, because if they're doing that, then you could just do it yourself. Passive index investing is one of the best ways for DIY and kind of do-it-yourself investors to manage their investments. But a lot of advisors take a similar approach. Now, the reality is, and I was just looking at this for a client, his advisor was charging 1.4% asset management fee with 10 different funds to basically recreate an 80-20 portfolio. I was able to recreate that portfolio with 2 simple ETFs that have an expense ratio combined of about 0.05%. So when you factor in a higher expense ratio of his funds as well at 0.46%, there's almost a 1.8% difference between the fees of the advisor as well as the funds themselves relative to basically an identical portfolio that has very similar performance. Now, this is why you should not be paying that advisor that much money to manage those investments. Now, my approach, it's a little bit different. I call it dynamic investing, and it's all about understanding the risk environment that we're in. Does it make sense to be more or less aggressive? Because based off economic, market, world conditions, it can be fairly clear about if it's a good time to be aggressive or it makes more sense to be conservative. I didn't want to just put my portfolio in a 60-40 and have this massive bond allocation and underperform a significant portion of the time. And for a lot of people still in that building wealth and accumulation phase, it makes sense to take risk. But it doesn't make sense to lose a lot of money. And that's what I learned from studying professional investors. They focus on, how can I not lose money? How can I take risk when it makes sense and manage that risk effectively? And so that's really what we do at Off the Beaten Path Financial, is work to understand the risk environment and adjust the portfolio accordingly so that we have a better framework around, does it make sense to be more or less aggressive? That allows you to capitalize on market growth and be involved in growth type investments, but not necessarily have the level of risk with the significant, 30-40% drawdowns. And when you do that, it means that your portfolio is going to compound at a much higher rate over time when you minimize those losses, but not necessarily miss out on all the opportunity of that potential growth.